Welcome to the IG Investment Channel. Today we're discussing climate change and the transition to a low carbon economy. It is, according to our guest today, one of the largest megatrends of the 21st century. Welcome to Gabriela Herculano, a fund manager at the iClima, Global Decarbonisation Enablers UCITS ETF. Quite a mouthful.
Quite a mouthful. Thank you so much for having me.
But this gives us an opportunity to drill down into what's going on here. First, remind us why we should be so interested in this area.
91% of the global GDP is committed to net zero. That is potentially a figure that we don't talk about enough. In this current market of 2022, where many investors see fossil fuel as the winner, liquefied natural gas as the winner of this energy crisis that we're having, that coexistence of green growth and brown value is quite dramatic. And it almost looks like the energy transition is going to be a no transition or a slow transition. If you take the share price of many of the companies that are really leading and accelerating that energy transition, it kind of feels like we're not on the right path, but we are. And I would love to explain to you why we think that is.
Before you get onto that, as an investor, why should I be interested just at the moment? My feeling is, from having read around this subject, is that it's very early days. We don't know yet the direction of investments, and it could be for some people too early to get in. What's your point about that?
What we do know is that there's not a scenario where renewable energy is not going to be the predominant source of electricity on the planet. That's a fact, and it's not because we're tree huggers. That is because the solutions make economic sense. Because solar panels and batteries, they're not fuel, they're technologies, and we get better the more we produce them. And we've been, this empirical evidence that we've been in this deflationary trajectory. One of the things that I love the most about the Inflation Reduction Act was the fact that you're putting together the idea of deflation with solar panels, because that's exactly what it is. So all the economies on the planet are going to be embracing renewable energy in many different ways. So we will be doing things, I do agree with you, Jeremy, that we have never done before, like how to solve renewable energy intermittency. We don't have a grid that is predominantly renewable. So for us to do that, we have to have what's called long duration energy storage. Germany is going to lead the way, in our view, for a variety of different reasons. They have to accelerate that energy transition. They don't have the natural gas from Russia anymore, so it has to be done, otherwise the economy will suffer dearly. So we will see the seeds are already here. We're talking about technologies that already exist and are proven and are accelerating that adoption.
It's an interesting point about Germany. Why is Germany so far ahead in your mind? Is it because they have a history of having a lot of engagement with the green lobby? They are very well represented at government level with the green lobby and have been for many years. Is that the reason why Germany is apparently so far ahead?
There are a few reasons. Germany is already 51% renewable energy based. The natural gas from Russia is not coming anymore. Nord Stream 2 will never happen. So Germany has to accelerate the energy transition. And they have a very favorable legislation, you're right, but also they have no nuclear. They have chose to go down the path, unlike their neighbor friends, of having a grid that has absolutely no nuclear. So you have to scale up utility scale solar, behind the meter, which is the solar rooftops solar, wind onshore and wind offshore. 2% of all Germany will be covered by wind farms. That's the numbers from the government themselves. So that acceleration needs to happen. And when you get to that 7 to 75%, again, we're about 51% penetration from renewable energy sources in the electricity grid. You need to have the long duration energy storage, because as the naysayers like to point out, the sun doesn't shine all the time and the wind doesn't blow all the time. So we need to store the surplus electricity so that we can use on another point in time. And the long duration energy storage means that we're going to store electricity from the summer, where the days are very long, to the winter. And I do agree that has never been done before. There are a lot of companies where that free cash flow is much more forward-looking in this risk-off market that we are right now, that gets deeply discounted. But that's where the value is. And then if you think from a risk perspective, one side of the economy is, without a shadow of a doubt, in our view, going to be growing tremendously fast, when the other one, you're going to have to time that exit, right? Is a dying product. I like to remind investors in the first lockdown, you will remember this, Jeremy, in the first lockdown, the whole planet was without moving from point A to point B. So that demand for crude for transportation evaporated to the tune of 20%. WTI went negative, never seen before. The next time the 20% of the demand for crude will disappear is not going to be temporary. It's going to be permanent.
But that's a long way off.
Well, the World Energy Outlook came out with a research just a few weeks ago, and they expect the emissions from fossil fuel to peak in 2025. It's almost Christmas. It's almost 2023. That's around the corner. That's short term. And then we have three very massive trends globally. That is Europe replacing natural gas, because a lot of that comes from Russia. Asia replacing coal for a variety of reasons, but also because it's extremely expensive. And the US replacing crude, because most of the demand for crude is for transportation in the US market, because electric vehicles are here and they're very cool. And they're getting to that parity point, and the adoption now with the IRA and the fiscal stimulus for that adoption, it's game over.
You spoke at the COP26 conference last year in Glasgow, which I think was hailed as a success. And then, of course, came the problems with the gas and so forth, and the inflation, potential recession. This year's COP, again, where you were representing a view, what do you talk about at those two conferences? And in your mind, were they very different conferences from what I've just explained, very different sort of background economically?
Very different backgrounds. The world changed dramatically, right? In a few months, COP Glasgow November, invasion February 16th. So the world has, these energy crises. We were already in a natural gas energy crisis back in November last year, but then of course the invasion exacerbates that. So we talked about our metric, which is potential avoided emissions. We're stepping on the shoulders of great people here. Mission Innovation developed this framework out of Paris Agreement back in 2015. And this is the idea that we live our lives most and foremost with high emission solutions, the way we eat, the way, of course, we move from point A to point B, of course, the way we produce electricity to heat our homes and for lighting and all of that, high emissions. So we need to move away from that. And we need to replace them with the alternatives that are much lower emissions. So again, drive that electric vehicle from point A to point B, charge that electric vehicle with solar panels, produce electricity from wind, eat a plant-based burger, use telepresence to communicate and not zigzag the Atlantic, right, with all the embedded emissions. So we have all these solutions. So this delta is called potential avoided emissions. It was quite a technical discussion. I was part of the UNFCCC last year and then this year. So we are quantifying this. And it gets quite technical. If I may just get into the weeds a little bit, we triangulate this figure of potential avoided emissions, which is a tangible forward-looking figure, is about what we don't emit in the first place. Because the best way to reduce carbon in the atmosphere is by not emitting in the first place. I think we are finally at the point where we're all agreeing to this. So we replace this. Does it move the needle? Then we triangulate and we bring from finance two additional concepts: time value of carbon, which is an equivalent to time value of money. The money in your pocket in the future is worth less than the money in your pocket right now. So does the carbon that gets not emitted, because the science is so clear, right? We are in a trajectory that does not keep us in the 1.5 degree scenario. Then we borrow another concept, which is return on invested capital, which we call carbon returns. How much is going to take? How much do we have to invest? Energy transition is about infrastructure. How much do we need to invest for that potential avoided emissions to materialize? So when we triangulate the three numbers, we can see where invisible hand will work its way through, and where investments should be deployed in what makes most economic sense. And that's where the conviction comes from, is because observing, it's a very, we think, objective observation based on quantification of what is relevant.
That's a really interesting word, objective, and using a number of different metrics and bringing them together and making decisions in this area. Just one question before we leave COP26, and it's a little bit of a tangential sort of discussion, which I don't want to get too deeply involved in, but do you think that the protesters are doing damage to the point you're trying to make, or do you think they're helping people be alive to what you're trying to say and what your fund is trying to achieve?
It's a good question. You look at the younger generations, they're going to be on the planet for longer. There's a sense of anger, there's a sense of anxiety because the dramatic situation we're already observing. The change in climate is here, right? Pakistan, a third of the whole country underwater.
Absolutely. It goes without saying that these events are happening. It's a question of whether or not the protesters are actually driving the real message backwards because they're highlighting the wrong things.
Well, what we believe is that capital markets can and should be a source of good. Yeah. Actually will be a sort of source of greatness, because we're going to solve this with investments. We're going to solve the problems by investing in the right things.
I think that's the key. I think I was trying to get at is the fact that this is a completely different way of looking at it from people with banners and throwing paint at paintings.
But it's hard to explain that capitalism that brought us here is the same capitalism that is going to save us.
That's an interesting point as well. And let's examine now the fund and get back into that opening point about what the fund's trying to do. What does the fund track exactly?
We track the companies that preclude emissions from ever taking place. There are two funds. There's the mouthful global decarbonization enablers, and that's the idea that we are looking to represent the companies that preclude emissions from ever taking place. So decarbonization as an investment strategy has been very much the story of less harm. It's been very much the story that overlaps with the story of ESG, of let's represent the companies that are reducing their emissions. We understand why we're coming from that. It goes back to Paris Agreement in 2015. Well, let's all do our fair share, reduce our emissions. The low-hanging fruit is to procure energy from renewable sources. You clean what's called Scope 2 emissions. So Amazon, Google, and Microsoft, they correlate very well with that. Rightly so, great corporate citizens. But if you're telling the story of decarbonization as less harm, you're telling the story of decarbonization as a cost line item. You're missing the exciting investment opportunity here. The exciting thing is to be in line with decarbonization as a revenue, because that's where you are seeing innovation. That's capitalism at its best, with the companies investing CapEx, R&D, bringing more products to market. And that's where we think the phenomenal investment opportunity is. And that's what we call ESG 3.0, is the future. It's about causation, not correlation. It's about that tangible indicator, the potential avoided emissions I was talking to and presenting at COP. It's about then showing the companies that really enable that avoidance. And here we are, and there's a triangulation of, you have a lot of robust tailwinds, the Inflation Reduction Act, Repower 55, across the planet. You have consumers embracing the solutions for other positive externalities. Everybody loves to use a Zoom. Everybody loves I love the Beyond Meat burger. It's better for your health. So we have other externalities. And then, of course, we have, with the energy crisis, the demand destruction that comes from fossil fuel, and that impetus. Let's just replace this volatile commodity.
The point about the food thing, I don't want to go down that route because I think that's something that is for another podcast. But I agree with a lot of what you've just said. And in fact, it's an interesting stat you gave at the top about the fact that 91% of total GDP is awake to what's happening with the earth and so forth, and what needs to be a carbon neutral environment. You've 172 holdings, I believe, in the fund. That's quite a large number as a fund manager to keep in touch with.
Yes.
But it also means there's a wide spread as us investors looking at this as an opportunity. What do you say about those holdings? How are they spread across sectors?
We have 5 sectors and 27 subsectors in the decarbonization enablers, and we represent some trends that I think are not yet well understood, and they change everything. And it is that convergence of these trends that really is going to reshape the planet. We're very hopeful. What we're talking about is changing 3 of the largest industries on the planet: transportation, energy, and buildings. And what, for example, epitomizes that idea of convergence are the solar panels. And we're not talking just about the solar panels. We're talking about aggregating monetizing and optimizing these assets, which is called vehicles to grid and virtual power plants. So it goes way beyond just putting the solar panel on your roof and having that ability to go almost self-sufficient. You're not going to go off grid, you're going to go almost self-sufficient depending on where you are on the planet and what kind of latitude. But even as here in London, we'll have a good shot if we have that battery. So it's that convergence of these two technologies, the solar panels and the batteries, that change everything. So Uber, Lyft, and Airbnb, they did that for car ownership and property ownership, gave the asset owners that ability to optimize and monetize. That's happening as well with what will now be really big investments for a household. The solar panels, the stationary batteries, the batteries inside the electric vehicles themselves. And here we are again with that impetus to improve our energy efficiency. I was delighted to hear our new chancellor last week talking about energy efficiency. Let's just not write checks. Let's make people earn that by achieving different levels of energy efficiency. Smart meters, smart thermostats, better insulation. This is all here. It made sense. It was very inexpensive for us to heat our homes in the most inefficient way with all that natural gas that we had. Those days are numbered. Heat pumps are here. We're going to replace that. So all these solutions that I just mentioned, heat pumps, smart meters, smart thermostats, all of these is very well represented in CLMA. We wanted it to be comprehensive. We wanted to be a one-stop shop. And here's another very interesting point. The rate to play, in our view, decarbonization right now is the thematic way, because it's too premature to call winners, to go all in on Tesla. Tesla was actually not the best performing stock in the EV space in 2020. It was NIO and BYD, and that was not our best performing segment. Fuel cells and electrolyzers, which are a proxy for that green hydrogen, which is a whole new economy that is going to unfold. So own large cap, mid caps, small caps, own different orders of innovations, the kind of pure commoditized products like the smart solar panels and the smart meters and the microinverters, a company that is a darling everybody loves, Enphase. There's conviction, I think, from on both sides of the aisle that company, for example, is a winner in whatever scenario. But then you go to the companies that are doing more battery as a service, the solar panel as a service, that vehicles to grid, that virtual power plant. That's like a further along the line of the innovation curve. And then, of course, you have the whole green hydrogen, which a lot of things need to happen for that whole economy to unfold. That is very forward-looking. So you need to have a good mix. Otherwise, you're taking a lot of risks, and you're not monetizing on the companies that have that short-term impetus behind them.
You said the word risks. I think this is an interesting point to talk about the risks of getting into this investment. What about interest rates going up, inflation, the potential for recession? As you said, as we discussed earlier, the two COPs you spoke at, very, very different economic environments. And here we are now having to cope with all these extra elements of risk within the economies. How does that impact on investments? Because my understanding is that with less money, which as consumers, certainly here in the UK, we're told we're now going to have less money to spend, I want to go for something that's good value to me. And that doesn't tend to be the sort of things you're talking about for companies that are producing things, because it tends to be more expensive because they're having to make these extra efforts and go down the route of being more green, which is more expensive.
Not necessarily. You have to do the calculation. It's like the EV. If you just take the sticker price, you go, this car is more expensive than internal combustion engine. But look through the maintenance, look through that residual value. Again, going back to risks. If you're in Norway, 75% of all the cars are already electric vehicle. Who is going to buy your internal combustion engine? And what about that residual value that you have in your second largest purchase? That's risk. That's a loss. We think that, yes, fiscal stimulus does help. The IRA is going to give a lot of impetus to all those house owners that need predictability. Is called the trilemma, right? How do you decarbonize when you have predictable cost and guarantee of supply? And I think that many homeowners in the US will solve that equation by saying, well, I'm going to go almost self-sufficient with the stimulus that math becomes an easier math. That payback time is going to be shortened. We are at about 4% penetration. There's 100 million homes in the US with suitable rooftops. About 3 to 4% only of those homes have that type of equipment. So we are at the bottom of that S-shaped adoption. And here's the interesting thing about the risk and the reward. At the current prices, there's a lot of there's risk everywhere in this difficult market, but it could be potentially a very exciting entry point, because you get in once you are at that 10% adoption, and when it's game over for the incumbent players, the business as usual, in the direction of travel, then the risk perception for the world that we're representing is then not so discounted. But then you would have missed already a potentially really beautiful rally.
Let's talk about then investments in this fund, and I think you know very well the shape of the share price, which if you look at the chart, you can see that going back to November 2021, we had this spike. Since then, there's been this pullback, and we've traded pretty much sideways within a band since then, and here we are now where we are. What do you say about how the curve of the share price goes, representing what it is you're trying to achieve and the potential? Because you're saying opportunities are here now to buy into what is going to be a very rewarding future on this particular fund and others like it. That's the message I'm getting.
Yeah, so 2020 was a phenomenal year for both funds. Biden administration was likely the winner. Market knew he was going to, day one, go back to Paris Agreement. That impetus on energy transition, clean energy was going to be there. CLMA closed the year up 83% in US dollars. So that was fantastic. 2021, we started seeing the rotation in February with that mostly on the economic side of things. And then, of course, 2022, this is where we are. That coexistence of green growth and brown value will persist, because this energy transition is absolutely inevitable. It's not going to be orderly, so it's going to remain bumpy. And there will be a lot of investors that will continue to want that free cash flow that comes from fossil fuel in the next few quarters. We actually are very concerned about inflation coming back up in early 2023. Once Europe starts to build up inventory for natural gas, if we are lucky and we have a mild winter, maybe that's not going to happen now, but the risk is still extremely high. Then we're going to go back to that very high fossil fuel prices, which in turn help with the demand destruction, which again give more impetus. We cannot live our lives like this. We cannot run countries like this with a fossil fuel. It's been volatile since the 70s, right? It's nothing new, but now it's quite dramatic. And now, for the first time, we have alternatives. We before never had these technologies at this price point where we are right now. And the convergence of everything changes everything. It is that inexpensive renewable energy electricity that is going to change everything, and is going to enable, for example, the green hydrogen, for us to do with green hydrogen all the many things for the industries that are very hard to abate, like fertilizers, for example.
Do you think governments could do more to promote all this? From a personal point of view, I'm trying to put solar panels on my roof at home, domestic, residential, and I've got to sign a certificate. I've got to pay for a certificate to do it in order to make sure if I do surplus generate, I've got to pay it back to the system. So it's making a big hurdle for me as a person. Do you find regulation is not as sympathetic as it could be for people doing all this?
Without a shadow of a doubt, and that's where all countries and all governments need to do. You need to streamline the permitting process from everything from the small scale solar to offshore wind. If you take a country like Australia, for obvious reasons, right? The abundance of shine, but also their permitting process is a single rule, is a federal level that permeates across all counties. So for a homeowner, they don't suffer like you're suffering, Jeremy, to put a solar panel right there. And that really means that the speed, and then therefore the cost of a solar panel installation in Australia is a fraction of the cost in the US. And that's bad. Inefficiencies are always bad, and inefficiency at some point will be solved, and most likely with technology. But if we have governments like Ursula von der Leyen, those are the numbers herself. So let me emphasize these numbers. We're talking about 600 gigawatts of solar That's the European Union target between now and 2030. Half of that, that's not my expectation, that is their official number. Half of that will be solar panels. Half of that will be at the point of consumption behind the meter. That changes everything. We are moving away from this centralized fossil fuel grid that is very volatile and expensive and with very high emissions to a grid that is very decentralized, is very digital. It optimizes all those assets. Not the time to do a load of laundry, not the time to charge your car, your electric vehicle. And we are going down that path, and all the solutions are here. And that's exactly what we represent with the second fund, which is, we think the name is a good one, Smart Energy, because that energy is a very different one. It moves us away to a really complete different grid. And let's not forget that one of the many bottlenecks for this infrastructure is the grid. It is those transmission lines. So as we decentralize and become more prosumers, again, that term was not coined by me, that's the European Union coin. They expect that in 2040, about 87% of all Europeans will be prosumers because they will have one of these assets, whether it's batteries or solar panels, at their homes. This is going to change everything. And here we are with the impetus to accelerate that transition.
Okay, I'm going to wrap it all up at the moment. I want to get one final question in. What's the message then for investors? As I say, this is an investment channel. We're talking about opportunities here with the iClima Smart Energy UCITS ETF. What's the message to investors that might be thinking, it might be a little bit too early, let's see how it develops, what's going to happen?
Well, there are risks. There's no doubt that there are risks. But in our view, the direction of travel from, a very objective point of view is that we are on the right path. A few things need to happen, but that demand destruction is in place. The technologies are in place. They continue to go down that downward slope despite the supply chain issues. So if you look at the big picture, it's crystal clear. We are in that beautiful path, and we're going to end up with a grid that is much greener. So we're finally aligning what is better for people, what is better for the planet, with what is better for profit. Because these technologies being technologies, they're not fossil fuels, the companies could be very profitable ones, but there will be new household names. Tesla now is, of course, ubiquitous and known very, very well, but there will be other companies that we are representing that are not yet well so understood, and there's not a world where we're not going to solve renewable energy intermittency.
This is one of the things that I was educated very briefly, very quickly in your list of companies you covered. But it's an interesting subject, and thank you so much indeed for coming in.
My pleasure.
It's been a pleasure to talk to you. That's Gabriela Herculano, fund manager of the CLIMA Global Decarbonisation Enablers UCITS ETF.